Welcome to the Finance Storyteller series. In this video I'm going to discuss depreciation and related topics. Here's an overview of the terminology we're going to cover. Let me take you through the underlying concept first and then address some of the specific questions you might have about the topic. What is depreciation? How does that work? Let's assume you want to buy a truck for your company. You spend $100,000 to buy it. We usually call that an investment in fixed assets. You could also call it capital expenditures, CapEx in short. What happens on your balance sheet, the overview of what you own and what you owe, is that cash goes down by $100,000 and your fixed assets or plant and equipment go up by $100,000. It would be incorrect to book the full $100,000 straight away as a cost for the current year in your income statement because you're going to use the truck for multiple years. Once you put the asset into productive use, depreciation has to be recorded. Let's assume that the truck has a useful economic life of 5 years and has no residual value. If you use straight line depreciation, you book $20,000 per year in depreciation. The value of the asset on the balance sheet goes down by $20,000 per year, and in the income statement you charge this $20,000 as an expense. Now that you get the main idea, let's define depreciation more precisely. If you see this pencil as a fixed asset, then depreciation is the sharpening of the pencil. The more you use the pencil, the more you will have to sharpen it, and the shorter the pencil gets until it is eventually fully depleted. In short, you can see depreciation as a pencil losing its pencilness. Now that definition won't get you through an accounting exam or make a big impression in a business meeting, so here's a more robust definition. Depreciation is the accounting process of allocating the cost of tangible assets to current expense in a systematic and rational manner in those periods expected to benefit from the use of the asset. Let me read that to you again to let it sink in. Depreciation is the accounting process of allocating the cost of tangible assets to current expense in a systematic and rational manner in those periods expected to benefit from the use of the asset. That last part of the sentence, in those periods expected to benefit from the use of the asset, is called the matching principle. Expenses should be recorded during the period in which they are incurred. Depreciation is often referred to as a non-cash expense. The cash was spent when we bought the asset. Depreciation allocates the value of the asset over the years in which we use it. We don't pay depreciation to anyone. In order to determine the depreciation charge per year, it is important to assess upfront how many years you realistically think you can use the asset. You then align the number of years that you depreciate to the number of years of the asset's useful life. We bought a truck for our company for $100,000 with a useful life of 5 years, so $20,000 per year. We also bought a machine for $100,000 with a useful life of 10 years, so $10,000 depreciation per year. Finally, we bought an office building for $100,000 with a useful life of 20 years, so $5,000 depreciation per year. If you are able to extend the useful life of an asset beyond the original expectation, then that is economically beneficial to your company, assuming the maintenance cost of the older asset doesn't go up dramatically. Let's say that after 5 years of use of the machine, we have solid engineering data that suggests that we can use the machine for a total of 15 years rather than 10 years. We then take the remaining book value of the machinery, which is $50,000, and divide that amount over the remaining estimated life. So in years 6 through 15, you would depreciate the machine at $5,000 per year rather than $10,000 per year. Here's how you account for depreciation. Let's take the truck which we purchased for $100,000 and use it for 5 years. When we bought the truck, we put it on the balance sheet for its full value. When we start using it, we book a cost of $20,000 per year as a debit in our income statement, or P&L. And the offset of that journal entry is a credit to a balance sheet account called accumulated depreciation. If you want to know the book value of the truck at the end of year 1, you net together the historical cost of the fixed asset and the accumulated depreciation on the balance sheet, which in the case of the truck would be $80,000. In year 2, you repeat the same depreciation journal entry and get to a book value of $60,000, and on for years 3 and 4 and 5. As you can see from these journal entries, depreciation is not about putting money aside for buying a new asset once the current one is at the end of its lifetime. Depreciation takes the amount you spent to buy the asset and allocates a proportionate amount to each of the periods of its useful life. Hopefully, the company that we are looking at generates very profitable products or services with the building, machine and truck that they are using, and the cash generated with selling these products and services can be used in the future to buy replacements for the assets that are at the end of their lifetime. What can you include in the value of the asset on the balance sheet when you buy it? This depends on the accounting rules that your company applies, which in turn depends on the country where you are located and whether you are accounting for tax or statutory purposes or for reporting to the stock market. Generally, what you pay for the asset to the supplier, as well as transportation and installation costs, can be capitalized. Capitalization means recording things as fixed assets on your balance sheet. IFRS and the US GAAP have different guidance on the level of detail, the number of sub-accounts that you have to use when recording fixed assets. Also, the minimum spend or threshold can differ between companies. Items below the threshold get booked as expense straight away in the year of purchase and don't go through the capitalization depreciation cycle. So far, I have explained depreciation as a linear process. You depreciate the same amount every year, all the way until the asset is at the book value of 0 on your balance sheet. This would be line number 1 on the graph. However, a linear pattern might not be the most fair and accurate representation of the asset's value. There are other approved depreciation methods, check your local regulations to see which ones apply, that work with a higher percentage of depreciation in early years and a lower percentage in later years. The book value of the asset then looks more like curve number 2. It's important to have consistency of method in the way that you depreciate assets. A company could change from linear depreciation of its trucks to a depreciation based on units of production, which in the case of trucks would be mileage, if that represents a more fair and accurate representation of the value of the assets. However, you can't be flipping back and forth between methods randomly every year, as that would adversely impact year-over-year comparisons, and it would not come across as very systematic and rational, per our definition earlier on. You also have to estimate upfront whether there is any expected residual value or salvage value at the end of the lifetime of the asset. What is the asset likely to be worth at the end of its useful life? If you have credible estimates supported by data that you will likely be able to sell the truck after 5 years for $10,000, then the total amount to be depreciated over 5 years would be $90,000, which under a linear depreciation method would be $18,000 per year. Last point. What is the difference between depreciation and amortization? Is this the same thing or something completely different? Well, the concept is the same, but depreciation and amortization are applied to different types of assets. You depreciate a tangible asset and amortize an intangible asset. The threshold levels, minimum total spend, and capitalization criteria for intangible assets tend to be a lot more stringent than those for tangible assets. I hope this was useful. Thank you for watching. Please subscribe to the Finance Storyteller YouTube channel. More videos coming soon.